Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Going through the Beige book, the anecdotal summary of what is going on when it comes to overall economic activity in the Fed's districts. Economic activity grew slightly in 3 districts, while the number of districts that reported flat or declining activity rose from 5 in the prior period to 9 in the current period. Employment levels were steady overall, though there were isolated reports that firms filled only necessary positions, reduced hours and shifts, or lowered overall employment levels through attrition. Still, reports of layoffs remained rare. On balance, wage growth was modest, while increases in non-labor input costs and selling prices ranged from slight to moderate. For more on this, we turn to Stephen Blitz. He's chief US Economist at Global Data, TS Lombard. He joins us here in the Bloomberg Businessweek studio. Important to keep in mind, this is anecdotal evidence from the Fed's districts.
Right.
But it does give a good idea of changes from different periods of time and how employers are feeling about the economy. What are your takeaways?
Well, I wouldn't downgrade the fact that it's anecdotal information, because if you go back to the time leading into 08, 09, they valued and they learned in their sort of, Monday morning quarterbacking of going in, the value of anecdotal information. And I'm really not surprised by what this said, because if you look at the economic data that's coming out, right? And I expect the Friday employment number not to be particularly surprising in either direction.
So in line with expectations.
Yeah, in line with expectations. In other words, I don't expect minus 100,000 or something like that. But what this number tells you, this tells you why Powell said what he did at Jackson Hole, making for a Fed chair, a very blanket statement saying, the easing of labor markets stops here. All right. And anecdotal information is very important to them at turns in the cycle because they lead the data.
So how are you thinking about all the data that's coming in right now? Because it really seems like we're in a situation where the market, at least, is very sensitive. They don't want to see, for example, a labor market that's too hot. They don't want to see one that is too weak. How are you kind of putting all of this together?
Well, I think on the edges, right, there's no recession, right? And so on the edges, you see weakening economic growth. The July personal income data was actually pretty good, especially on real spending for discretionary items. In other words, not counting food, energy, rent. So it was actually pretty good, right? So this is unusual for most cycles in that this is really about the Fed easing before recessionary data takes place, as opposed to their usual, which is catching up, right? And they don't want to be in catch-up mode, right? And by anyone's model, the funds rate is at least 100 basis points too high. So the real question is, how fast do you get down there? And the data will determine that. The market is figuring that once they do the 25, the data will soften enough to scare the market to do like a 50 in December and then another 25 in December, and that's how you get your 100, right? The moves after that, right, is really in anticipation of the funds rate going down to adjust for an inflation rate by the next year is 2% instead of 3%.
I'm looking at labor markets in the Beige book. It says that employment levels, Steve, were generally flat to up slightly in recent weeks. Few districts reported that firms reduced shifts and hours, left advertised positions unfilled, or reduced headcount through attrition, though accounts of layoffs remained rare. Employers were more selective with their hires and less likely to expand their workforces, citing concerns about demand and an uncertain economic outlook. Is this, coupled with the JOLTS data that we got earlier today, is this a return to normalcy?
Well, that's the question, right? And that's been the question all along as to whether or not this is just a return to a normal economy or whether this is a precursor to recession.
What do you think?
I think that what I'm reading here, this is typical precursor of a recession.
You said we're not in a recession right now.
No, we're not. We're not in a recession now, to be very clear, right? But before firms start to lay people off, right? What do they do? Just in our own experience, right? They slow wage increases. Maybe they don't give wage increases. They cut travel. Business travel is an important, ask, hotels what they're seeing in business travel, not vacations, but business travel. And then they cut hours. And then there's unfilled positions, and they say, you know what, we're not going to fill this position.
We've been hearing for 2 or 3 years that a recession is just around the corner. Why? And it hasn't arrived.
Well, we haven't gone around enough corners yet.
Okay, maybe we haven't. What's different about this environment?
Well, the difference is that this is not a normal cycle because there was a mandated shutdown and then a mandated reopening, which was COVID, right? And you had a tremendous amount of fiscal stimulus along with that. And so you had this unreal, unsustainable 6% growth, whatever it was in 2022. So the economy is going from 6 down to 2.5. So, which is its normal cycle as the impact of all this stuff kind of washes through. So it's very hard to tell what is just returning to normal and when are you going past that. Now, the Fed really didn't get tight until late last year, earlier this year. And my favorite indicator is the inversion of the real yield curve. So real 3-month yields versus real 10-year yields. And that inverted last November. And that's about a 12-month till, on average, which is always a dangerous number, but on average is about 12 months, which puts you into coming into recession at the end of this year. But of course, it's not necessarily fated if the Fed does what it wants to do in terms of easing financial conditions. And the key one is to actually cut the cost of short-term financing.
Which they're set to do.
Which they will do 25 in September, unless there's a big negative surprise. Right? There's no upside number. Like let's say it's 250,000. That's going to keep them, especially given this anecdotal information, that will keep them from cutting 25. So the question is 25 or 50, and you would need a really poor employment number to get 50.
Steve, we're going to have to leave it there. Stephen Blitz, Chief U.S. Economist at Global Data, TS Lombard, joining us here in the Bloomberg Businessweek studio. Always good to see you.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Well, superlatives abound when talking about what happened with Nvidia yesterday. Shares fell more than 9.5% at a race, nearly $280 billion in market cap. It lost more than the market cap of Adobe, which is one of the 30 biggest stocks in the U.S. market. Shares higher by about 0.3% as we speak. Then after markets closed, Ian King and Leah Nyland exclusively reported that the U.S. Justice Department sent subpoenas to Nvidia and other companies as it seeks evidence that the chipmaker violated antitrust laws, an escalation of its investigation into the dominant provider of AI processors. We got with us Ian King, Bloomberg News U.S. semiconductor and networking reporter, joining us from our San Francisco bureau. Ian, the dust has settled a little bit in the last 18 hours, 20 hours or so since you and Leah reported this story. As the dust settles, remind us, what is at issue here and what the Justice Department is alleging?
I mean, the important thing is that this is a subpoena. They've been surveying NVIDIA's customers and competitors. Now they've moved to a subpoena, which, as you know, is a legally enforceable requirement to provide information. So what we think in terms of what this signifies is that they are moving closer towards launching a formal complaint alleging that NVIDIA has transgressed rules here.
Remind us what NVIDIA has said thus far about these subpoenas.
Yeah, in response to our story, they came back and they were quite feisty. They didn't deny the facts. What they said was, look, people buy our chips because they're good. If they don't, they can go elsewhere. So really, showing a degree of irritation, I would say. With this, they believe in truth in engineering. They believe that they are where they are because they are the best engineers for this type of product.
So what is at the core of the DOJ probe? What part of NVIDIA's supply chain are they really looking at here?
Yeah, I mean, we won't really know that until there's a formal complaint filed, but our reporting basically shows that what they're looking at is the idea, and this is something that's happened in the chip industry before with companies like Intel, Where if you make multiple products for a data center, such as what Nvidia does, networking, software, they supply software models, services, and the chips. Say if you only want to buy the chips, maybe you're paying more. Maybe you're not getting the kind of supply that you want compared to those that are buying everything. That's one of the examples that's sort of been thrown around. Maybe there is some kind of pricing differentiation going on that the customers don't like or think is unfair. All of these kind of ideas when you have a company like Nvidia, which is so utterly dominant in one area.
Okay, well, you bring up a good point, Ian, that it is utterly dominant in this one area. And you said, well, essentially the response has been, if you don't like our product, you can go elsewhere. Can customers really go elsewhere?
Sort of. I think the problem, obviously competitors such as Intel and AMD are really, it's taken them a while. I think AMD is closer, but still not really at the level that Nvidia is at. And Intel, by its own admission, is kind of trailing far behind. So in that sense, no. But there are other aspects to this. A company like AWS, Amazon's web services, they do their own networking. They do their own servers. They do their own software. So maybe they just want the chips. Maybe it's hard. I'm giving you a hypothetical here. Maybe it's difficult for them because they don't want to buy everything. So that's the kind of argument that exists, that maybe some of these companies that have the expertise and the ability to do a lot of it themselves want just the chips and want those chips on fair terms.
What do you make of the move in the stock? We saw obviously Nvidia fall almost 10% yesterday, but it's actually in positive territory right now. Is that move justified with the news that you're reporting?
I think you would have to ask my markets colleagues a little bit more about that. Looking at what was happening yesterday, and this is before our story went out, there was, obviously all of the chips related stocks sold off, and those that had been tied to this kind of AI frenzy were amongst the leaders, and obviously Nvidia led everybody because of its market cap. It had a huge impact on the indexes and particularly chip related index. So that had happened pre to this. What we should do is probably separate the short-term fluctuations between the long-term impact of something like an antitrust investigation, which will take a long time and which will likely be appealed if there is an investigation, if there is a formal complaint, and if the courts decide in favor of the government's case whenever that is brought. Okay,
whenever that is brought, Ian, help us understand and help our audience understand what the next piece of this puzzle would be. What are you watching for?
Yeah, there would be a formal complaint would be the next step. We have to say in that regard, these things typically have taken years, actions against Microsoft, actions in the past against Intel, and quite a lot of them have, very little material impact on a company's fortunes because guess what? Technology moves quicker than the legal system. But at the same time, it's clear, not only in the US, but worldwide, that AI and who controls it, who controls these vital pathways, is a clear, strategic, geopolitical security focus for governments around the world. So I think we could take this as part of a broader look at these things, and obviously an influence that governments feel they need to bring to bear upon this market.
Hey Ian, while we have you, we'd be remiss if we didn't ask you for your view on what happened yesterday when it came to the stocks, when it came to the chip stocks. We saw all 30 components of the stocks down yesterday. The stocks had its worst day going all the way back to 2020. There was this UBS note that came out yesterday, but other than that, why did we see such a decline in chip stocks yesterday?
It's look at the multiples, look at the run-ups that we've had this year, last year. It's clear that a huge amount of money has been shifted into this sector, and it's happened very, very quickly. Nvidia being the prime example of that. When you get that kind of concentration, you obviously attract a lot of retail investors and a lot of people who don't potentially have the knowledge. So you have a lot of, what people will call fast money coming into a sector which traditionally didn't really have it. So that's going to make any rollover, any sense that perhaps we've got ahead of ourselves a little bit, even more precipitous when people get nervous and when they pull back. That is one explanation of what happened yesterday, and we've seen that happen recently, and then guess what? The money came rolling back in again. So you would have to ask, long-term investors and short-term investors what their viewpoint is and what their bias is. But to me, that is the kind of explanation that I've heard that makes most sense to describe what's going on.
Well, we certainly appreciate that explanation. We certainly appreciate all the coverage that you and the team covering Nvidia and other chip companies. Ian King, Bloomberg News US Semiconductor and Networking reporter, joining us from our San Francisco bureau. Now we're going to talk Intel, because the Biden-Harris administration's big bet on Intel to lead a U.S. chip-making renaissance is in grave trouble. This as a result of the company's mounting financial struggles. It creates a potentially damaging setback for the country's most ambitious industrial policy in decades. So writes Mackenzie Hawkins, Bloomberg News US economic and industrial policy reporter. She joins us from Washington, D.C. Mackenzie, Intel is supposed to receive $8.5 billion in grants and $11 billion in loans. That's as a result of the CHIPS Act from 2022, but only if the chip maker meets key milestones. Where is Intel right now in relation to those milestones?
So President Joe Biden went to Intel's factory site in Arizona in March and announced this massive grant and loan package from the CHIPS Act in what could be and would be the program's largest award. And Intel, like more than a dozen other companies that are supposed to receive U.S. government subsidies, is in the middle of a pretty intense due diligence process that comes after reaching that preliminary agreement earlier this year. And once the company signs a final term sheet and hits milestones on each of 4 projects that Intel's CHIPS Act award is supposed to support, they could start to receive funding from the government in the form of a reimbursement for company spending. But Intel has resisted certain due diligence requests from the Biden administration and had a pretty disastrous financial report early last month that calls into question whether the company will ever be able to reach the milestones that would trigger that disbursement in the first place.
So what is the U.S. really looking here when it's examining these milestones? Like, what exactly are the milestones that Intel has to meet?
So the government has been actually pretty quiet on the milestones. They're very bespoke arrangements that go on not just a company by company basis, but a project by project one. So in Intel's portfolio, for example, you have everything from an R&D facility in Oregon to a small packaging project in New Mexico. And each of those facilities have different timelines, different milestones, and different portions of Intel's grant that would fund those projects. But across the board, one of the key metrics for the Biden administration is general commercial viability. And the best way for a company to demonstrate that is by lining up major customers. So if you compare Intel to a company like Taiwan's TSMC, which is widely regarded to have the world's best semiconductor technology and has orders from pretty much every major tech name in the books, Intel doesn't actually have any major customers lined up for its U.S. facilities. It has some interest from companies including MediaTek, Broadcom, and Microsoft, but none of them have reached full production yet. The Commerce Secretary herself actually reached out to executives at Nvidia and AMD and asked them to consider manufacturing at Intel's Ohio facility, which could become the world's largest chip-making factory if it's fully built out, and neither company plans to do so.
Hey, Mackenzie, how did this story change just in the last month? Because at the beginning of August, Intel reported earnings, and it was the worst single day in decades. As you know, 2 major credit raters downgraded the firm's debt to just a few notches above junk. The chip maker also slashing about 15,000 jobs. How did this story change just in the last month?
So the process that Intel's going through right now, which is the preliminary agreement followed by months of due diligence ahead of a final award, was always the process that the company was going to go through. But of the entire CHIPS Act portfolio, which includes companies like TSMC, Samsung, SK Hynix, Micron, Intel has perhaps seen the biggest change in the company position in the industry from when that preliminary agreement was announced to now. And so we're in a bit of a holding pattern. The Biden administration and just about everybody else are waiting to see what the company will do, and they're set to evaluate options at a mid-September board meeting. So if the company does something like split off its manufacturing division or scale back its global factory plans, that could have an impact on its negotiations with the Biden administration. And to put a finer point on it, and there isn't an indication yet that this is happening, but if the company does decide to pare back any of its U.S. plans specifically, that would almost certainly cause a reduction in its overall CHIPS Act award.
I'm wondering if maybe we can zoom out, just for people who are just tuning in now. Why has Intel not been able to kind of capture that frenzy that there is, at least in the market, for semiconductors, Nvidia is the top performing stock in the S&P 500. It's been a huge theme this year, and yet we have Intel, which is a very well-known name, and it just hasn't been able to ride that wave. The stock is down something like 60% year to date. Just get us up to speed on exactly what they're missing.
So, Intel is an American technological giant. This is the company that gave Silicon Valley its name. But there have been several years of strategic and technological blunders that CEO Pat Gelsinger came into leadership of the company aiming to turn around with a massive bet on Intel's factory division for factories that are known as foundries in chip speak. But the foundry business has struggled. They posted a $7 billion loss last year, and they missed out on a big AI wave that companies like TSMC have been able to ride. And so now Intel is sort of playing catch up against foreign competitors, and their technology still lags several generations behind the cutting edge. And they've struggled to convince major other players in the industry who get the bulk of their orders for AI chips from the industry leader, TSMC, to take a bet on their factory processes. So it's a bit of a spiral for Intel right now as they're trying to convince investors, convince the government, and convince industry that their technology is worth taking a bet on.
Mackenzie, on the U.S. side of this, the U.S. government side of this, the support that Intel was set to get from the U.S. government is set to get from the U.S. government. What does the U.S. government want to see? Is this about jobs? Is it about security? Is it about both?
So if we go 30,000 foot and look at the CHIPS Act overall, this was a landmark law that was that President Joe Biden signed just about 2 years ago last month. And the goal is basically to bring manufacturing of these critical electronic components back to the US. Chips are in everything you could think of, from a microwave to a phone to a nuclear missile. And for decades, the US has ceded manufacturing leadership to Asia. The pandemic revealed to everybody how important chips are. It was a shortage of even less advanced chips that caused auto supply lines to shut down during COVID. And governments around the world, not just the US, but from the EU to South Korea to Japan to Taiwan to, of course, China has decades of industrial policy in this area, are really doubling down and trying to make sure that they have a stable and secure domestic manufacturing base for both economic and national security. The jobs, of course, are an added bonus, but this isn't a jobs program. The goal is to get the world's top chip makers, and the US has gotten commitments from all of them, including Intel, to build significant manufacturing presence on US soil so that the country can make a fifth of the world's most advanced processors by the end of the decade.
But you say, and you write in your piece, that this is a long process. I mean, you go back to the Obama administration, and Intel was talking with the Obama administration for something that they ended up building and touting during the Trump administration.
That's right. And, one of the big difficulties facing the Biden administration is, they're looking at point in time company financials and market conditions, but this is an intensely cyclical industry. And as much as companies would like to make promises to politicians, they'd love to stand with Biden at a bill signing or go to the Oval Office. The reality is that they're beholden to their shareholders and to their customers. And so you have a strategy employed not just by Intel, but by other major companies as well to build factory shells, do what is cost billions of dollars, but is actually the cheap part of the process, and only outfit them with actual equipment when they can see, 6 months down the line, 9 months down the line, exactly what their demand picture is going to look like. And so right now you're starting to see a lot of the signs that you would want to see if the country were going to meet its, decade end goal of making all of these chips at home. But that's in factory construction, not in actual equipment purchases. And so there are a lot of other indicators to watch to see whether companies will actually make good on their production plans in the timelines that they have set out with the administration.
I wanted to talk about that timeline. What do we know about what's next for Intel and how much time they do have before they would be set to receive those billions of dollars in grants?
Intel would love to know the answer to that question. Very active negotiation. There are companies that are quite close, but we haven't actually seen any CHIPS Act money go out the door. All of the announcements, of which there are more than $30 billion committed, have been in the form of these preliminary agreements, like the one that I described, Biden announcing for Intel in March. And so all of the companies are going through due diligence, actively hashing out the specific dollars and cents that are correlated with, X production milestone milestone, X customer commitment. And it's, a very company by company basis. And so really what Intel is feeling right now is not necessarily like, oh, we're worried our CHIPS Act award is going away. That would only happen if their US factories went away. And Intel hasn't made any decision to that effect. But it's about the timing. Intel has a balance sheet that's in pretty dire straits, and they want to get this money as quickly as possible. But that'll only happen if they cooperate with due diligence. They have resisted some requests from the Biden administration so far. And of course, if they actually get their factories off the ground, which requires the company to invest billions of dollars itself.
To what extent does the US government need Intel to succeed? I'm not asking if it's like too big to fail, but is it too important to fail?
Intel's crucial to the overall CHIPS Act effort. There are only 3 companies that make the types of advanced processors that the US is really, really focused on in this effort, and that's Intel, Samsung, and TSMC. And both of the latter companies are building factories on US soil, but to get to a fifth of the world's production, especially when governments around the globe are trying to do the same thing, you really need these large-scale commitments like the ones that Intel is making. I mean, they're planning multiple fabs in Ohio and multiple fab expansions in Arizona. So to potentially lose those projects or to see them delayed, which again, we don't really know what's going to happen on that front, would be a pretty massive blow to the overall ambition of the program. Intel's also the only American maker of these chips, which the Pentagon has decided is really crucial for Department of Defense supply chains. And Intel's the sole intended beneficiary of a $3.5 billion program to stand up a secure facility to make semiconductors for military and intelligence purposes. So will the CHIPS Act fail if Intel fails? No. There are hundreds of companies that were interested in the money. More than a dozen awards have already been announced. But it's impossible to overstate how critical Intel's investments are to not just the company's turnaround plan, but also the Biden administration's goals.
Mackenzie Hawkins, Bloomberg News U.S. economic and industrial policy reporter.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Data centers and transmission networks each account for up to 1.5% of global consumption. That's according to the International Energy Agency. Together, they're responsible for emitting about as much carbon dioxide as Brazil annually. So over the summer, we learned that new data centers planned for Silicon Valley have the potential to add 3.5 gigawatts of demand for electricity. This according to PG&E. It's more than the output of 3 nuclear power plants. Emily, needless to say, all of this computing power is using a lot of energy. Josh Patterson is trying to do more with less at Voltron Data, where he's CEO and co-founder. It's an analytics software startup backed by firms including BlackRock, Alphabet's GV, Lightspeed, and more. Josh joins us from Charleston, South Carolina. Josh, good to have you with us. Welcome to Bloomberg Businessweek. You were at Nvidia for about 4 years before you co-founded Voltron Data. What was the problem that you saw when you were at Nvidia that you set out to solve?
Absolutely. At Nvidia, I joined specifically to drive GPU acceleration in data analytics. Prior to Nvidia, I was at Accenture Tech Labs, and we were working on cybersecurity challenges. And what we realized is we had the algorithmic and systems technology to solve really large-scale threat detection, but it was prohibitively expensive. Moving, parts of the software stack to NVIDIA GPUs allowed us to shrink different parts of it down tremendously, moving from 40 servers to a single server and being much more energy efficient and faster, moving graph analytics from 30 minutes to 30 seconds. And so after that, we really caught this bug. How can we GPU accelerate all of data analytics? How can we help bring GPUs in data systems? And that's what I joined NVIDIA for. There, I created the Rapids.ai ecosystem. It's all the modular and composable building blocks for building software for data analytics, machine learning, graph analytics, et cetera, on NVIDIA GPUs. And our whole goal was data is going to keep growing. And so we know we have to be able to analyze that data faster, cheaper, and with less energy.
Okay. So help us understand, maybe in
I mean, I get it. Come on. Just kidding.
in maybe simple terms, if you had to explain this to, someone, your elevator pitch, or, explaining this to your grandma, what exactly is a GPU, and what exactly is Voltron, producing here that is reducing the energy consumption that these big data centers take
Absolutely. And so the first thing I would do is always do a, kind of an analogy. We know for a fact that NVIDIA GPUs are the leaders in AI. AI would be, prohibitively expensive. It would be borderline impossible without the innovation, from V100 to A100 to H100, and now the B100s coming out soon. And, GPUs are essentially these multi-core chips that allow you to do parallel data processing a lot faster, a lot more energy efficient. And it's been the building blocks of graphics, high performance computing, autonomous vehicles, and AI, as we all know. What we're doing is we're taking that exact same speed up and we're applying it to databases. And when you think about a database, it has three layers. You have how you store data, how you manage data, how you actually do compute on the data, and then how you talk to that data system, your APIs. How do you send instructions? And so what we do at Voltron Data that is pretty unique is we run that database compute. So not the data warehousing, not how you store data, not how you index and sort data, but the actual how do you join tables together, how you do group bys. Think about all the things that you do in Excel, but just at a much, much larger level. Instead of megabytes of data, we're talking about terabytes of data. And we do that running on NVIDIA GPUs. We primarily focus on that middle layer, that's just the compute, and we allow people to bring their own APIs to our engine. And that allows that integration to be a lot faster and more seamless. And so whether you're using one of the myriad of SQL dialects, a Python data frame API, a Java data frame API like Spark, you can send your existing code to our query engine that then grabs data from your data lake and analyzes that data really, really fast. And so, essentially we can take workloads that used to take 200 servers and we can run them on 2 servers.
Wow.
And it's faster. And that's how we get to these, pretty, amazing energy reductions today.
Where are the servers that you're running these queries on?
Both in the cloud and on-premise. We have customers who do air-gapped on-premise installations. So think about your Department of Defense and your intelligence community agencies, as well as high frequency trading firms where for a myriad of privacy reasons they don't want their data centers having free access to the internet. Traditional data centers that you would find in Fortune 500 organizations, your top banks, retailers, et cetera, as well as in the cloud. And so we can run our software across all major clouds. The only prerequisite is NVIDIA GPUs. That is the backbone of what Theseus runs on. And then from a kind of a big data, how do you schedule and orchestrate it? We use Kubernetes, which is the foundations of cloud native technology. So we're cloud native and we're accelerator native. We were built from the ground up to fully leverage NVIDIA GPUs, accelerated networking, and storage.
So how's business so far? What kind of customers do you have? And have you seen, I guess, an increase in them? Because I know you're a new company.
We're a new company. We were founded in 2021, but we didn't really launch Theseus until this March at NVIDIA GTC. And that's where we released our benchmarks, showing that we can scale to hundreds of terabytes of data with single digit number of servers. Business is doing well. We've signed some really great deals with a few of the intelligence agencies, a very large commercial bank, one of your Fortune 100, top 5 banks. And we also have about a dozen customers that we're doing enterprise support and advisory for around open source software. And so think about your high frequency trading firms, Snowflake, and others are customers of our enterprise support. And these two things work very graciously together. So first, we help people use existing open source software as efficiently as possible. And that is things like Apache Arrow and Ibis and Substrate and Parquet. And so they can build these better data lakes. They can build interoperability. They can have these, more efficient composable systems, but it also allows them to more graciously upgrade to these GPU accelerated query engines when they're ready. And so both sides of our business really is revolving around how do people do more with less? How do they, continue to use their existing code? How can they leverage best practices in open source to drive enterprise value today?
Josh, you're based in South Carolina. Is your company in South Carolina?
We are fully geographically distributed. We have engineers from Japan to Australia the long way. Probably about 2/3 in the US, 1/3 global, and pretty distributed across the US.
Is that
pretty high concentration?
You see that as an advantage? I mean, when we talk about companies such as yours, Silicon Valley is the geographic location that certainly comes to mind for a lot of these companies.
So when our company was born, it was born out of a kind of an amalgamation of some of the world's best talent in hardware engineering, software engineering, database design, high performance computing, as well as Nvidia GPU know-how. And that talent is very rare. And so if we wanted to move everyone to one place, it would have been expensive. And so this was one of the ways that we could really keep our costs as low as possible while building the world's best engineering team, and it allowed us to build this really amazing engine. I would say faster and more capital efficiently than ever before historically. Typically, people spend 4 to 5 times as much building a data system than we did, and that's really because even from our time at Nvidia, we were geographically distributed.
Right.
Some of our leadership team, and we've been fully remote, probably some of us since 2016. So even pre-COVID. And so this was a working model that we were very used to. It's very common in open source, and we leverage it to our advantage.
Josh, come back and visit us again. Really appreciate you joining us. Josh Patterson, he is co-founder and CEO at Voltron Data.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, it's time for Drive to the Close with Thomas Raymond, investment management partner at Callan Family Office. He joins us here in the Bloomberg Interactive Brokers studio. Welcome. Thank you for joining us.
Thanks for having me.
So, Nvidia was down today, but the notes that you sent us had a lot to do with AI. Where exactly are you seeing opportunities in that part of the market?
Yeah, well, first off, perspective matters a great deal when the markets are choppy like this and you have a sell-off, especially with the magnitude of Nvidia's decline the other day. But Nvidia is not another Netscape. There is a clear difference between that company and what we saw in the tech craze and the tech bubble. Right? I mean, the earnings and revenue numbers that we've seen are 100% growth year over year. It's not the same, right? So kind of put everyone's mind at ease, it is not the same. But what we are seeing, and one of the theories that we've kind of had was that there's going to be a shift from AI producer to AI consumer, and there'll be various benefits from that. And that could unlock a huge productivity and innovation wave.
Are we seeing that yet with S&P 500 companies? I mean, every quarter I'm like listening on these calls to hear about how a company that's not an Nvidia, for example, that's not actually producing the products or building the services that is doing this analysis are actually using these tools to improve their bottom line.
Yes, you are, in some unlikely places.
Okay.
So Walmart, let me give you an example. Walmart is not typically considered a tech company, but you look at what they said, their CEO said in their most recent earnings announcement. And by the way, they outperformed on an earnings basis. They said that they were able to catalog 850 million of their items through the use of large language models, AI. Right? It would have taken them 100 times their workforce to replicate that work in just a fraction of a time. That's just one example. That is Walmart. Visa was another one. A couple years ago, they saved $25 billion in fraud detection from the use of AI. There are a lot of examples out there of companies that you don't think are tech companies, but man, they start to look like them. And there is this push to be more asset light. And more clear evidence of this is earnings growth, right? In the first quarter, the Mag 7 names had earnings growth of just those 7 companies of 50% plus earnings growth year over year. The other 493 companies, down 2%. Mm-hmm. In the second quarter, there's been a convergence. There's been a normalization of the earnings growth from the Mag 7 names and growth on the bottom line. The delta now is around 20 some odd percent because the Mag 7 earnings growth came down, but the rest of those other 493 companies started to go up. So it is an earnings story, right? The cost savings that you get immediately accrues to your bottom line when you embrace this, embrace AI.
So where does that leave big tech then? Because you're still seeing a big appetite to buy those Apples, Alphabets, Microsofts, and when you look at how much of Nvidia's customer base is those companies, they do make up a large portion. So do you hold? Do you sell that area?
Well, time horizon is the controlling factor in this, right? For those that have the ability to embrace the volatility along the way, tech is it's not going away. It will be a bumpy ride. But let's just fast forward into a couple years and all these upstream effects from AI. Take the robotaxi. We're here in New York. I don't see any robotaxis just yet.
Yeah.
But they're in San Francisco.
You can't walk a step. You can't walk a block in San Francisco without seeing a Waymo.
Yeah, but that's not possible without AI. And we're not necessarily endorsing the Teslas and the Waymos and the Baidus of the world, but having staple positions in tech into those AI and those companies that are embracing it, it's something you need to have, but you got to have the perspective and the time horizon to support it.
Okay, speaking of perspective, everybody's favorite topic, politics, the election. Coming up. We've got a couple months until, wow, that's crazy, actually, when I say it like that. A couple months until the election.
Literally a couple.
Yeah, literally a couple months. How do you see that as a risk out there?
So I've heard there's going to be an election as well. And I'm in a swing state. I'm in Pennsylvania, so I hear.
So every other ad you see.
Every other ad is a political ad. How we're approaching it is, there's going to be it feels like a toss-up, but to make an investment bet predicated upon a certain election outcome never really works well. What we would reshape the narrative to is some of the sure things, right? Some of the more certain items that are about to come about. One being interest rates, right? We know interest rates are going to come down. The path is clear, whether it's 25 or 50, that's up for discussion, but we know it's going to come down. We see Fed fund futures. It's going, and we have had a Fed that's committed to transparency and open communications and proactive communications. We know interest rates are going down. That's one certainty that will play out, irrespective of who wins in November. The other certainty is we're still going to see a lot of unspent government dollars, right? There's $1 trillion. There's $1 trillion of unspent federal dollars that's still out there from the Inflation Reduction Act and things like that. That's still coming. There's still going to be a federal spend that's going to influence the economy. So there's some sure things that are out there. We would always advise not to have political ideology influence an investment decision. It tends not to work out well. Try to kind of reorient and make decisions based off those more certain things that we see coming.
We have a big payrolls report coming on Friday, and we also got labor market data today that showed a weakening labor market. How are you thinking about jobs in the U.S. right now and how it impacts markets?
Well, it's that derivative effect into Fed policy. And the reality is from the economy, from an economic standpoint, what we saw when rates went up, we saw that the economy isn't as sensitive to rates as we once saw. There's 25% of homeowners refinanced when we had ultra low rates. Now, the opposite effect will hold true. We may not get that juice when rates start to come down from an economic standpoint. We will get it from a lot of, from a financial market standpoint. A lot of companies that have floating rate debt, typically small caps, smaller companies as compared to larger companies, they'll benefit somewhat more directly from that. So it's the economy from a rates perspective, and then there's the financial market effect.
You're saying we might not see pent-up demand because a lot of people already have low mortgages.
Correct, yeah.
Okay.
Yeah, I'm one of them.
Yeah, well, a lot of folks out there, I forget the statistic. It's like something like 80% of people have sub 4% or something like sub 5%.
Yeah.
I don't know. It was.
Yeah.
I don't have the stat off the top of my head,
Yeah.
but it is a large number of people. And remember, that's fixed. So
It's over 20 million homeowners refinanced to ultra low rates. So it kind of that dynamic has desensitized rates to the broader economy at large and spending. So the jobs report, it's meaningful, but in terms of its where rates are going and that interplay, I think there might be an overstatement of where things can go.
And Thomas Raymond, investment management partner at Callan Family Office, joining us here in our Bloomberg Interactive Brokers studio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.